Hello traders, are you ready for FOMC? Big volatility expected in less than 23 minutes. Sorry, phone call. Okay. Indices, to be honest, I would favor one more drop to the downside. Now regarding what else? You want Trump? You want gold? You want euro? Gold, we smashed it today, really. We sold in the morning, we bought back, we sold again, we bought back, we sold, now we are flat. You are trading in XNES. Do they offer copy trading for Europeans, you know? GBP, what a pair. GBP will follow the euro. Typically still in a downtrend. Let's see. I'm gonna buy the dip, I'm gonna sell the rip. If that helps. Let's see what Powell has to tell us, but it's very strange meeting us. We have the new President Trump, Mr. President, that wants everything at no cost. He wants tariffs, he wants lower yields, he wants stronger dollar, stronger indices, he wants everything. He wants Greenland, he wants Mexico, he wants Canada. But he doesn't understand that all those things have a price. Talking about yields, let's check. Yields, what to say, consolidating here, 450, 457. Same for the bonds. Now I wanna buy this S&P future, but better wait. Dun, 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 dun. I think we are one of the very few, if not the only one, that covering and trading live in the FOMC from YouTube channel. So you are lucky to be here. And if you press the like button, we will become even more bigger. You want to put in coin? I want to. Maybe I should mint it. We see some dollar buying right now. You can see that in the 5 minutes. Oh, let's see. 15 minutes almost. The really big surprise would be a cut today, as nobody expects it. Only hopes, for example, Trump hopes for a cut. It won't happen, but okay. It would be really the event of the year. Nice. What? And nothing is moving. Here we are. Okay. 7 minutes. Crypto. Bitcoin. This question mark was on Sunday. We decided to break lower finally, but still huge support on the downside. Now reacting higher. Maybe we test for another time 107.80 and then down. It's all the same. Broke to the downside, this triangle. More clear here. Ethereum dead meat. Always lower highs, lower lows. It is dead. Trap shitcoin consolidating here. Nose. Maybe we see something here moving. Yields pushing higher. Okay. I'm drinking my 7-Up. I might have to refill. Smoking my favorite Monte Cristo Club cigarillo. Let's see if we have something. Tomorrow as well we have ECB, Central Bank's tripleta this week. Bank of Canada earlier didn't do much. Okay. Let's see. 1 minute to go. And here we go. Unchanged as expected. Dollar is rising, no surprise. Gold is falling. Full statement out. Let's see the analysis. Gold is pushing. I wanna buy some gold. What do you think? At 45, $2 lower. Stocks pretty much same. Come on now, gold. I wanna buy you down here. It's around 45 in spot. You can find the link for the Tradify in the description. There is big discount, 50% until end of January. Rates steady as expected. The FOMC statement contains only minor changes, mark-to-market recent economic developments, labor market conditions remain solid, inflation remains somewhat elevated, we will have to wait for Powell speech. Oh, Fed removes reference to inflation making progress towards goal. That's why we had the drop. This is hinting to the hawkish side. Come on, gold, fill me. Give it to me.
Order filled.
Damn, I bought in the wrong account. Shit.
Order filled. Order filled.
I'm going to refill my 7-Up. I'm coming back. Okay, what did I miss? Nothing. We are gonna have to wait for Powell. Everything is risk off now. Stocks, gold, FX, crypto. gold is fighting. Give us 45. Okay, besides this hockey stone, I don't see anything else in Fred's statement. Yields going higher. Good for Trump. Another headache. Come on. Ten minutes for Paul to start speaking. Only gold is making a new low for the day. Strange. Let's see if we break this downtrend. The buy at 45 might be premature, but it is a good support level. Initial at least. of his cable. This is gold. It remains heavy, to be honest. Powell is getting ready to speak, to give us his speech, the speech. Stocks getting hit pretty much in the lows of the day. Maybe we see a squeeze now higher, at least in the opening range area. Okay.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years.
Okay.
Labor market conditions have cooled from their formerly overheated state and remain solid.
Okay.
Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
Okay, we are waiting for you.
Recent indicators suggest that economic activity has continued to expand at a solid pace.
Okay.
For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and 4.1% in December remains low.
Okay.
Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance.
Okay.
The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the consumer price
$5 profit in
data
gold,
indicate
not
that total PCE
mal,
prices rose 2.6% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Order filled.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate.
Okay.
Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak.
Hello, Richard.
That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks.
Okay.
We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy accordingly.
If it doesn't rain,
Policy is well positioned
it
to
will
deal with
have
the risks
sun.
and uncertainties that we face in
if it
pursuing
won't
both
have
sides
sun,
of our
it
dual
might
mandate.
rain.
As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its
Powell
discussions by reviewing
looks
the
like
context and outcomes of
he's
our
sitting
previous
his
review
pant
that concluded in 2020,
because yields are
as
still
well as the
going higher.
experiences of other central banks in conducting
This
reviews.
irritates Trump.
Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we'll be open to new ideas and critical feedback,
Again,
and we'll take
reversal.
on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Bam bam, 5 minutes only. This was quick.
Steve Richmond from CNBC.
That was quick.
Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately.
Yes, I was waiting for this question.
Question: has the president done this to you? Has he made that demand?
Demand.
Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions.
3 questions, but only
I'm
one.
seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Could you just comment on whether he's physically communicated this demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has
What
changed.
a bump!
I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending.
Here we go!
And if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is it no longer the case?
No. So if you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the long run, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
A big move happened.
Michael McKee for Bloomberg Television and Radio.
See you all tomorrow.
Your colleagues normally condition.
I will try to cover live ECB.
The economy develops as we anticipate.
So have your.
Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?